Hey, good morning, everybody, and welcome to this Tuesday, April 15th, 2025 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats. It's a pleasure to be with all of you again this morning. Don't forget your taxes. It's tax day, April 15th. Anyhow, probably just ruined a lot of people's day. But yeah, we got a market that still mostly remains in sideways fashion. I mean, obviously we've been in a downtrend, but we've been kind of consolidating since setting a low earlier at that 48.30, 48.40 area. And again, if you recall, that was the breakout level. That was the high that we set first back in the beginning of 2022 before the cyclical bear market. We'd gotten up to about 4,800 or so. I think the intraday high had reached about 48.19. And then we had the 9-10 month cyclical bear market that ended in mid-October of 2022. And then we started making our way back up. So we went from 4,800 down to 34.91, I believe was the low, and then worked our way all the way back and ultimately did break back out to all-time highs, getting through that 4,800 level. And the pullback that we've seen of late has been more of a test, long-term test of that breakout of that 4,800 area. And so I still look at the current range, and it's a wide range because we've had so much volatility. I mean, when the market is going up or down 3, 4, 5, even 10% in a day, you're going to have a wide range as opposed to when you have a VIX that's at 12. And, you've been in the S&P 500, you've been in a range maybe of 125 or 150 points. That's completely different. So you have to expect that we're going to have big moves as we move forward. Some will be good, some will be bad, but really the key is, do we break down or do we break back up? I think that's going to be the next big test for the market. So again, watch about 4,800 to 48.30 to the downside. To the upside, I would say the number's 55.21. That's where we broke down from recently. Haven't gotten back up there yet. We got close that day where we saw the NASDAQ move up 10% in a day, maybe 11%, whatever it was. We did see the S&P 500 get up close to 5,500. Didn't quite make it, but got close. So that's the key level. And everything else that's talked about, I mean, I look for my secondary signals to provide me some clues as to possible movements forward to the upside or to the downside, but it's always the price action that confirms it. And so even back in 2022, when I talked about a cyclical bear market or the potential of one in 2022, dropping as much as 25% and up to 6 months or so, that's kind of what I recall talking about. I said that, there are certain support levels that we'd watch on the way down. I felt like we'd go to 4,300 when we were at 4,800. That was a key support level. And I said, if that breaks, that's kind of your confirmation that we are likely to get a bear market and move down that prerequisite 20% or so. Same thing now. We're just going the other direction. So right now I'm seeing some bullish signs. I'm seeing some rotation signs that are much more bullish. A lot of sentiment signals. I mean, volatility, when you get the volatility up to what we're close to 60, I think I saw a candle the other day where the open was at 60. I never actually saw 60. I saw about 55, 56, but still, I mean, really you're splitting hairs when you talk about the VIX at 55 or 60. So we got that. Normally, if you look back at history, you see those kinds of moves to the upside in the VIX to help mark bottoms in panicked markets. So that's check mark number one. We have the equity only put call ratio, which still not quite sure. I was sent out a member or our weekly market report to members. And one of the things I talked about yesterday was the fact that, I couldn't reconcile the equity only put call ratio at the CBOE.com website to what stock charts was showing. Well, I've since found out that what stock charts is showing is exactly what CBOE is reporting on its on its market statistics page. But the market statistics page is not the same as what we're seeing in the hourly put call readings or half hourly put call readings. It's on a different area of the CBOE.com website. So good buddy of mine over at Stock Charts. Many of you, I think, know Julius from a lot of the work that he does with RRG charts and a lot of the sector rotation stuff. He also handles a lot of the data stuff over at Stock Charts. So Julius will be, we've been back and forth, going back and forth with emails lately, trying to figure out what's going on. And he's going to look over at CBOE and see if he can find out what the difference is. Because normally I wouldn't really care. It's like, let's just go with whatever Stock Charts has. But there was one particular day, it was, I think a week ago, Friday, where we had such a big down day in the market. The VIX was up in the mid 50s. I mean, panic was in the streets. And I know from history and from experience that when you see that kind of panic in the market, the equity only put call ratio is going to be way up. It's going to be something like 0.9 or 1 or even well above 1, an individual daily reading. I think the record over the past 25, 30 years has been somewhere around the 1.35 or 1.37 area, which says that there's 1.3 puts, equity puts being traded versus one equity call. And normally that ratio is like 0.6. That's like 3 equity puts being traded versus 5 equity calls. And so, little flipped. When you get up close to 1.4, you're talking about 7 equity puts versus 5 equity calls, which is more than double the puts compared to average. So anyway, I've probably given you a lot more numbers and information than you need, but it does skew our readings. So Stock Charts for that Friday, when everything went down and we saw all that panic, Stock Charts showed a reading of 0.64. And the half hour, which was the exact number that was reflected in the market statistics page over at CBOE. But on the half hourly equity only put call page, the cumulative reading for the day was 1.17. Well, 1.17 versus 0.64 is a big difference. 0.64 is just like an average day in the market. But that Friday was no average day. That Friday, we were getting hammered. Big gap down on the S&P, continued selling during the day. We went down to 4,800. I mean, we were just at 6,100 less than 2 months ago. So, I mean, that kind of fear should be reflected in a high number on the equity only put call ratio, and 0.64 was not it. So I tend to believe the 1.17 number was the bigger and was the more accurate number for that particular day. And yet that's not what we were seeing. That's not what we're seeing when I pull up the 5-day moving average of the equity only put call ratio. So anyhow, my belief is that things were a lot more scary and panicked than what Stock Charts is showing. And Stock Charts still showed, I think, a 5-day moving average, which went up to like 0.73, which is pretty close to the 0.75 to 0.80 level that I look for to help mark short-term market bottoms. But when we get into the really panicked markets with a bear market, a cyclical bear market upon us, I look for a little bit more than that. And so 0.9 or 1.0, something like that, is a little bit more normal, I would say, in a really abnormal kind of a market. So anyhow, that still, I think that sentiment, along with the VIX, sentiment is telling us that, we should be looking out for a market bottom and perhaps a move back to the upside. But again, that doesn't confirm, at least in my view, it doesn't confirm until we get back through 55.21. So I think we're just range bound for now. And then the final sentiment nail in the coffin for me was Friday. We had the latest consumer sentiment numbers come out, University of Michigan consumer sentiment. And not only did it come in at 0.5 or 50, or not point, it's 50.8, I think was the actual reading. That was the second lowest reading over the last 50 years, telling us that consumers they believe we've got a mess on our hands. And, some of you, I'm sure, believe that, and rightfully so. I mean, we do have some issues. I don't think we have a mess on our hands. I don't think there's any reason to be panicking, but Yeah, I mean, we've got issues that we got to get through. The market always has issues it's got to get through. Sometimes I think they get blown out of proportion. I think that's what's happened this time. But panic, the market just craters. That's what happens when you get panic. There's no rational behavior, no rational market behavior when you start to get panic and folks see, that their portfolios are dropping rapidly. You're going to get some panic out there. And it's that panic that marks market bottoms. Now, the reason I brought up the consumer sentiment at 50.8 is not only is it the second lowest reading that we've had in the last 50 years, but every reading that's gone below 65 has led to a market bottom. When you get below 65 on consumer sentiment, you shouldn't be thinking quite so much about how low we go. We should be thinking about when should I be buying? And so now that we're down to 50.8, the only time that was lower, I believe, was recently when we had the 2022 cyclical bear market. I think it was, 50 at that point. But if you look back at some key times, like the financial crisis, 2008, the dot-com bubble, 2003, back at the beginning of 1980, after coming through the 70s and the oil embargoes and, everything going on, the Iran hostage situation, all of that coming out of the 70s, that was another time we were down at lows. Those were all perfect times to buy. That's where we are right now. So I'm seeing sentiment that's telling me to buy, but price action doesn't confirm, and that's our primary indicator. So you can, the thing is, a lot of folks will say, well, why, try to call a bottom? If why don't you just wait for price action? Well, the problem is if you wait for price action to get out, you're going to be way down. And then if you wait for price action to come back up, you're going to be way back up before you get back in. You're probably not saving anything. In fact, you might be costing yourself something getting out lower than where you get back in. So the purpose of these secondary indicators is when they all start to come together and you use a little bit of perspective and some common sense, they give you some signs to tell you, hey, things are bad. Yeah, I get it. But we're probably much closer to a bottom than we are the top. And it's time to start thinking about buying. And that's what I've been doing personally for a little bit over the last week. But the very end of last week, I went all in. I'm like, if we go down, we go down. I ride it down a little bit. That's my line of thinking. I mean, if you can wait, sometimes, back in 2022, in June, when I called the bottom, it was literally the bottom that day and the market took off. I don't really see that here because that was more capitulation that day. There was a lot of manipulation going on back then. We're seeing some of that again now. So the signs were there. I think the signs were maybe a little bit stronger than they are now. That it lasted longer because I started talking about a potential bottom in April. Or no, not April. I think it was in May of 2022. And it was a month later before I said the bottom's in. This time, it's like I'm seeing some of the same signs that I saw in May, but I just don't feel like the market is going to go any lower. I think we're already starting to see a lot of the changes fundamentally, like the tariffs being paused for 90 days, inflation. Those who are still calling for inflation last week, that was not a good report. If you're in the inflation camp, we had two inflation reports that were way below expectations. So I think a lot of the uncertainty right now dealing with the tariffs, dealing with the trade war with China. But we saw all this back in 2018, and we saw what happened coming out of that. 2019 was a great year for the market. So anyway, taking a long time here to talk about some of this stuff, but let me go ahead and make sure that you all get my screen, and we'll take a look at what happened yesterday. And let's go in here and take a look first at the Dow Jones Industrial Average. So the Dow yesterday was up 312 points, coming right up to test the 20-day moving average, by the way. So this has been an area where we've tended to struggle. Also, you can see the low in March on the Dow was about 40,800. And the big swoon that we saw early in April took out that support level. Now we're back up testing it. So I think this 48 to 41,000 level is going to be pretty big on the Dow. If we get through, if you see 41,000 printing and we close above that level, that is going to start to get things going a little bit more bullishly here on the Dow. S&P 500, I talked about 55.21. So let's take a look what I'm talking about. And I'm talking about that low right there in March, 55.21 on the close. Pretty sure it's 55.21, but let me double check. 55.21.52. We got down here to an open of 55.27. Intraday 54.88. So you can see these tails went below 5,500. We bounced back to the 20-day moving average, failed, and then moved back down again. This is a downtrend. This is, in my opinion, the definition of a downtrend, where you lose the 20-day moving average, the 20 drops below the 50, and then you just continue to trade below the 20. So looking at this, which is my primary indicator, we're still in a downtrend. Now, we did set a very important low, heavy volume low, high VIX low, high equity only put call ratio low, a high consumer sentiment low. So all of these, to me, this support area from, again, let's say maybe down to 4,800. I don't know if we go back down there again. I wouldn't be shocked to see us go back below 5,000. We're sitting at 5,400. So I'm prepared to potentially go back to that level if the market can't get through. But my secondary signals are suggesting that this is not going to last, that we are, like I said, closer to a bottom than to a top. And so where do we go if we pull back? If we can't get through the 20-day moving average, where do we go? Do we go back to this recent low here, 52.20? That's possible. Do we go down to the low the day before that, which was remember the big 10% up day, biggest, second largest day ever on the NASDAQ? You remember that? The very next day, the low was down to, on the S&P 500, 51.15. So after all that buying came in, there was a ton of buying that day. The lowest we've gotten since that day has been 51.15 on the low and 52.68 on that close. The next day we did open at 52.55. So, I mean, I'm just throwing out some numbers out there. This, like I said, it's a wide range. Don't be shocked if we're down 3-4% a day again, 5%. I think it's possible. The market right now is programmed. Well, I shouldn't say the market. It's more the investing public is programmed to, to see these big drops. They're almost expecting it. But again, when you got consumer sentiment at 50, there's a lot of folks out there think things are really bad. So when the market goes down 4 or 5%, they're thinking it's confirmation bias, because they're already biased toward things being very, very negative right now. And if the market goes down, that's just proving them correct. So that's what's called confirmation bias. You're looking for anything to prove that the decision you made to sell stocks or whatever you did was warranted. And so we'll see what happens. I try to remain objective. Anybody who's followed me for a while knows I'm generally bullish. I'm bullish unless the market tells me not to be. And the market goes up a lot more than it goes down. I mean, we've had over the last 75 years in the market, the market's gone up something like 57 of them, 56, 57 times. Well, I'm talking about calendar years. So of the calendar years since 1950, about 75% of them have been up. Only 25% have been down, which is why I think shorting and always being bearish is a losing battle. I mean, odds just tell you the market has a better chance of going up than down. So when you do get these down periods, especially if you see it coming, which we did, we talked about this late January throughout the first 3 weeks of February. And then we had this day toward the end of February right here where the S&P made this big drop. Wrote an article at Stock Charts. I said the top's confirmed. That right there confirmed the top for me. And that was the day the XLY went down all day long. The XLP went up all day long. Mass rotation from aggressive discretionary or aggressive consumer stocks to defensive consumer stocks. And that had only happened 9 times previously in history And all 9 times, well, eight times were part of bear markets. One time was part of a correction. So when you're looking at this market and you think, well, after that day, if it holds true, the S&P 500 is going to drop at least to 5,500. That's 10%. Just, going along with history. And look at all this selling that took place. And we got all the way down to what? 5,500. There was your 10% correction. Now, from there, it depended on the strength of the rebound. It depended on, the rotation that took place during that push to the upside. Never really impressed. The other thing I said is we needed to get through 57.82. That was this open right here was 57.82. This gap support over here was 57.82. So that was pretty key support at 57.82, and we lost it. And guess what? We came up, we tested 57.82, and we went back down, set a new low, and now on the way back up, 55.21 is the level. We've gotten close. That day that we had the first drop, our high was 54.99. So after when we gapped down, then we tried to get back through, failed, and rolled over. And then on this move back up, the day when the NASDAQ had its second best day ever, on the S&P 500, we got to 54.81. So we got within 40 points of it. And that was coming off a 4,800 low. And we did it in 2 days off of that 4,800 low. 2 days, 600 S&P 500 points. So, and with the VIX still elevated, we still have a VIX up in the 30s. I don't know where, we can take a look and see where we finished. But right here, the VIX finishes at 30.89. The VIX, and we've been coming down, which is good, but any VIX reading of 30 is still telling us that we should be expecting a lot of volatility. And volatility doesn't always mean, when it's high, it doesn't always mean we're going to go up. We could certainly see a big move to the downside. Let me give you the futures because I didn't even talk about that yet. All right, let's see. So start off with the Dow. The Dow futures right now, we're only 8 minutes from the market open. Dow futures right now down 0.1%. The Spider is down 0.04%. So essentially flat. The QQQ is up 0.1%. Again, pretty much flat. IWM down 0.25%. So a little bit more weakness on the small caps, which is really what we've been seeing for a while. Pretty much all the chatter about interest rate cuts right now has been tabled. So I don't think we're going to see a whole lot of relative strength in the IWM until the market believes we're getting enough information where the Fed very well could start thinking about cutting rates again. That might be next week, next month, might be next quarter, might be later this year. I think it's coming. The question is when. I don't have a crystal ball as to when the Fed is going to start, heading in that direction. So I've said before, I'm a fan of the IWM small caps. Just because it's underperforming doesn't mean I still don't believe that when the rate cuts come, that is going to be the index that is going to take off. But we'll see. Maybe I will be wrong. But we've had evidence in the past when we did see rates being cut. That was when we did see the relative strength in the small caps. So I certainly still hold out hope for the small caps going forward, but I also recognize they're not going to get their due as long as we're worried about tariffs and inflation and things of that nature. All right, so that was the VIX still up at 30. So we, as we get up to the 20-day moving average on the S&P 500, that's normally a level where we would see it top and start to roll back over again. So I wouldn't be shocked if we roll back over, but I'll be honest, I also wouldn't be shocked if we see the melt up above the 20-day, given the levels that we're seeing in terms of sentiment. And when I talk about a melt up, I'm not talking about going back to 6,100, but if we go back through the 20-day moving average and can negotiate 55.21, I don't think it's out of the question to see 57.50, even up to maybe 5,800. We could set an inverse head and shoulder pattern, left shoulder, neckline, head. We get through the 20 and through 55.21, we could make a run back toward 5,800, which would put in the right side of the neckline. And then maybe another drop back to 5,500, maybe to test that 20-day moving average, on the other side of it. I think that's possible. And I look at pattern. I try to predict patterns based on some of the signals I'm getting from sentiment and some other bottoming signals. And so once I feel like the bottom is in, or most likely in, that's when I start looking at how could this evolve into a more bullish looking pattern. Well, first thing is it's got to take out some key price resistance and moving average resistance. And then, we'll see. We could go right back up to that 57.75, 5,800 area. But can't get there without 55.21 first and the 20-day moving average. Got to get through both of those first. What else? Looking at the sectors, yesterday, we did see, it was a good day, but we did see a lot of rotation back toward defense. I will definitely admit that. I mean, I can see it on the chart. Real estate, utilities, consumer staples, healthcare, all leading as we're getting up to the 20-day moving average. I mean, that would suggest to me that we're probably not going through the 50-day, or excuse me, the 20-day on this test. Normally, and if we do, and it's that leadership, I'm not going to be that impressed with it. But the prior week and to week and a half, what we've been seeing is money rotating into more aggressive areas. So if you see us, if we do get through the 20-day, look at the sectors. Check to see what's leading this market to the upside through such a key area of resistance. And if it's the aggressive groups, it's got a much better chance of staying power than if it's like it was yesterday. I mean, those are all four defensive groups on top. That's not a good look. But we'll see how, if we get through, what's the makeup of that rally. All right, someone that I saw in the room, I think it was Greg or Rick, anyway, was asking about the 200-day moving average. And my problem here, I got a long-term chart, and the red line is the moving average, the 200-day moving average. Usually you don't see the 200-day moving average on my charts. And that's because I'm fairly short-term trader. And if I'm bullish, the market's bullish, we're not going to be anywhere near the 200-day moving average. By the time you get to the 200-day moving average, you've had a lot of issues. Again, if you're waiting and using the 200-day moving average as your line in the sand, a lot of times when you get out, if you use that to get out and then you use that to get back in, sometimes you get back in higher. I mean, it doesn't save you anything. Look at the pandemic in 2020. Big move through the 200 days. So you get out right in here somewhere around the 3,000 level. Well, guess what? When we broke back out above the 200-day, it was right around the 3,000 level. So you never saved yourself anything. You could have just ridden it down and ridden it back up, and you'd have the same balance in your portfolio. So to me, it's too late. If you're following the 200-day moving average, you're way too late to the game. And as far as calling a top, I mean, at that point, you've already gone through your 20 and your 50 and probably a ton of other warning signs that were out there. I mean, I'd rather see the warning signs when we're sitting at an all-time high. I mean, call me crazy, but getting into cash at an all-time high is a little bit better than doing it at 200-day moving average. So I just think the 200-day, it's like, you're going to a party on Saturday night, you show up on Sunday. It's like, okay, party's over. No reason to be here. So that's number one. And then there were questions. I think there was another question about breadth. The fact Dave Keller's been talking about breadth. I have a ton of respect for Dave. Great technician, great friend. But technicians, we don't all follow the same things. Not everything is, in the same pecking order in terms of importance. I mean, do I think breadth is a waste of time? No. Have I found in history that it helps me call the market? Not really. I don't. Breadth to me, well, it might not even be as good as divergences. Divergences, if you look back using hindsight, divergences they predict the market 100%. They're awesome because what you don't see are the negative divergences when you're going up and you pull back and you go up and you create a negative divergence on that high. Market keeps going up. The PPO goes up with it. The negative divergence gets eliminated. So the negative divergence that's printing on a breakout, if you see it at the time and you say, oh, I got a negative divergence, I'm going to get out. Well, a little bit later, the market goes higher and the divergence is gone. And you're like, wait a minute, I got out. Now I got to get back in higher. But if you look back, 2020 hindsight, there was no negative divergence because as the prices went back up, the divergence went away. So you don't really see it when you look back. And I kind of have that same feeling. That's why, by the way, with divergences, I always look for something else. I want to see it. I want to see that negative divergence hit like at a price resistance level, or I want to see a reversing candle off of with a negative divergence in play, or I just simply want to see the breakout level fail with a negative divergence. I got to have something else with that negative divergence. I don't just call the market based on a negative divergence or on a positive divergence. It's one of the secondary signals, and it needs other corroborating evidence. Breadth to me is similar, except I've tried using it. It just doesn't work for me. I mean, throughout the entire year, 2023, stock market was just going up, 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 up. And I kept reading articles about how everybody said the breadth was horrible. And I'm just like, well, the stock market's going up. And everyone says, what's the Mag 7? Ooh, that's bad for the market. It's only the Mag 7 going up. Newsflash, those are seven of the biggest stocks in the world. Kind of important when they go up because they're kind of a big deal in the major indices. I mean, I'd rather them be going up than going down. I just think that, they've got competitive advantages. And the competitive advantages keep growing as they get bigger and bigger and spread out into different areas. Amazon used to just deliver stuff. Now they're into the cloud, they're into AI, they can buy a company and just use their stock as currency. So the reason they're outperforming is they're just better than everybody else. They're more competitive. They have better customer service most of the time. There are reasons why they're going up. But the other thing that really just doesn't make sense to me is that folks that don't want to pay attention, that are using breadth indicators, they're not recognizing how many people these Mag 7 stocks employ. I mean, they're the largest employers in the world in many cases. And so, do I want a company that's out there with 10 employees or, a public company got maybe 20, 100 employees? If they're doing better than Amazon, which has, I don't know, a few 100,000 employees. I don't even know how many employees they have. They got a lot of them. Should I be happy? Should I feel better about the market because that smaller company is keeping up or doing better than Amazon? I don't understand the logic in using breadth indicators. So I don't use them. You don't see me talking about breadth. Anyway. All right, market just opened. I know I'm kind of going on a little bit of a rant today. Trying to think what else I wanted to show. I mean, for those who haven't seen it, I can pull up the S&P 500 and we'll go on a monthly chart. I've shown this multiple places, so most of you probably have seen it, but for those of you who have not, you might find this pretty interesting. But I'm going to go back 50 years on a monthly chart on the S&P 500. Don't need volume, don't really need moving averages. Don't need the PPO. What I do need is I'm going to pull up price and I'm going to put in $, UMC cent. That is the University of Michigan consumer sentiment. And we're going to make that big. And let's just see what we have here. So here's that reading I was talking about, 50.8. That's where we are right now. That's the reading. It just came out. back at the bottom of the cyclical bear market, actually near June. That was when I called the bottom in June, and everybody thought I was nuts. And you can see consumer sentiment back in the middle of June was at 50, the lowest reading in 50 years. Back at the end of the 1970s into the early part of the 80s, consumer sentiment was down at about 52. Persian Gulf War, it got down just below 65. Financial crisis, it sat down here between 55 and 60. 2 years later, 2011, when we were starting to roll over, you can see that roll over here. Folks were still very, very nervous, and sentiment dipped one more time into the 50s. But if you look at where the stock market was at each one of these lows and what happened after, every time consumer sentiment has been down into the 60s or 50s, you would have been very well served to have been buying every single time. Well, here we are again. You can make the call. Maybe this is different. Maybe we're going to see this consumer sentiment reading go to 40 or 30, which would be unprecedented. It would be crazy. It's possible. But I have a feeling if we come back and look at this another year or two, we're going to be saying the same thing about this consumer sentiment reading that we said about all these others. Should have been buying. I believe that we're going back to new all-time highs. I believe right now, it's still going to happen this year, 2025. Could it go into 2026? Yeah, that's what we saw back here in 2022. I said we'd go down the first 6 months, come back up the second 6 months. We ended up going down almost a year, and it took us another year to come back up. So I don't have perfect timing, but I believe that this is going to end the same way. We're going to be back up at all-time highs. So when we get there, there are going to be a lot of folks saying, well, I'm going to wait on the next pullback. I should have gotten in when it was at 5,000 or 5,400, but I can't do it now when it's at 6,200 or 6,500. So I'm just going to wait, and might be waiting another couple of years. And by that time, we're going to probably be at 9,000, 8,000, and the pullback will be to 6,800. And then you have to figure out how to get in or why to get in then. Anyway, that's it. The market's just, we go through these cycles. And so I just wanted to point all that out. Anyway, let's take a look. Actually, I'll get back to the market here in 1 second. I do want to point out for those of you who are new to Earnings Beats, first of all, even if you're not an Earnings Beats member, you're not even an Earnings Beats Digest member, which I don't understand if you're not. It's a free, no credit card required newsletter, which I'll show you in a minute. But even if you're not a member at Earnings Beats, you can still be a subscriber on YouTube. That's no cost. Just hit the subscribe button, and you can like our videos. That really helps us in our algorithms. So if you like what we do, you can't support us financially or even with the EB Digest. Again, you don't want to do it for whatever reason. Really simple. Just hit the subscribe button and hit that like button. So do that for us, please. Back to our Earnings Beats website. We do have a free 30-day trial to our paid service. You do have to give a credit card for that, but it's not going to get charged. And we will even reach out to you toward the end of your trial period to make sure that you want to stick with us. It's not like we hope you sign up and then just forget about it. We're going to remind you. Because if you don't want to be part of the service, if we're not helping you, then you shouldn't pay anything, shouldn't be a member. But we do also have a free newsletter, completely free, no credit card. And that's where you can sign up for it. Just scroll down at earningsbeats.com, go to the EB Digest, name, email address, hit that subscribe button, and you're good to go. And we don't sell email addresses or anything. You're not going to get spam from any third parties, nothing like that. You're probably going to get some spam from us. I'm just being honest, because we do a lot of events for our members. So we do reach out to our free community as well to let them know what's going on. All right, so let's take a look and see what's going on in the market this morning. Let's go back to the dashboard, see if we're up, down. Oh, we got nice action. So I know we had, futures looked like they were going to be a little bit red, but across the board, they're up. VIX down another 6%, now under 30. We don't get out of the woods with the VIX until we go below 16. To me, that is confirmation that we're not, I mean, the bear market's ended. We're not going to go back to a lower low. That's never happened in the stock market since I've been following. We've never seen the VIX in the middle of a downtrend, in the middle of a bear market, during rallies. We've never seen the VIX go back down below 16 and then the market crater again and go back down to a lower low within that same bear market. Because I've had people point out back in 2000 to 2003, and then again 2007 to 2009, we had a bull market in between those two. It was a cyclical bull market, but we had a bull market from 2003 to 2007. Not talking about that. I'm talking within the move down from 2000 to 2003, the VIX never went below 16. The bear market from 2007 to 2009, VIX never went below 16. The cyclical bear market in 2018, the trade war, VIX never went below 16. During the 2022 cyclical bear market and the 2020 pandemic, VIX never went below 16. This current bear market, we did have a bear market. The S&P got down just about 20%, maybe 21%, and then we reversed back to the upside. During this bear market, the VIX has not gone back down below 16. So what I'm saying is that during that particular bear market, we don't see the VIX go below 16 and then have further selling to go. That is, the bottom has always been in when that VIX gets below 16. So let's watch it. Again, we're still at 28. Bears are still alive. It's just that a lot of the other sentiment indicators are telling me they're probably not alive, but we'll see how it all plays out. Dow Jones right now up 168 points, 0.4%. S&P up 0.5%, 54.33. We are now 88 points away from 55.21. NASDAQ up 0.5%. Small caps up over half. They were the laggard in pre-market. Now we're seeing small caps come back and have a pretty decent day. Nice move today on Netflix, $9.62 up $30. Netflix reports on the 17th, which is Thursday, after the bell. So Netflix making a really big move here. Palantir making a pretty nice move, 2.6% up today. This is what I was telling our members last week. I got into the market, QQQ, Spider, IWM, and I looked at the Mag 7 and a few other AI stocks. I mean, that is essentially how I got back into the market. We've gone down a lot. I got into every stock I got into significantly lower than where it was back in late January and mid-February when we topped. So again, I don't know if we're going to break through 55.21. That's going to be a big level, but we are seeing a lot of signs that at least are telling us we're closer to the bottom than we are the top. So anyway, with that, I'm going to go ahead and wrap it up. We do have an event this afternoon for our members. That's our monthly Max Pain. That's where we take a look at where stocks could potentially go into what normally is options expiration Friday, but this Friday is Good Friday. The market's closed. So it's going to be options expiration Thursday this week. But we'll take a look at that tonight, give us some clues about possible trading direction the next couple of days and into next week. So if you want to sign up for that 30-day no-cost trial, now is a good time. Come right in and check out the Max Pain event this evening. But anyway, have a great day, everybody. And I'll try to keep you posted as best I can on what's happening in the market. Happy trading.